So let's move on. Let's consider those elements one by one. Asset. Asset is defined as one, a resource, bit of any kind, that is controlled by an entity as a result of what? Of past events, and from which future economic benefits are expected to flow to the entity. So it refers to what? It refers to a resource controls. There must be element of control. So the resource might be of the resource might be intangible form, or what? Or in intangible form. So they must be what? They must be in control by the entity. So if it's not in control by the entity, it is not we can't classify that as the asset of the entity, and was arise as a result of past events. So there must be a past event that has resulted to that. And the third part is that which the intention was is to generate economic benefit from what? From the expected flow of the entity. So the form of assets under the statement of financial position, we have two forms of assets. We have what? We have the non-current assets. The one that is what we refer to as well as the fixed asset, but according to development in IFRS, it is called non-current, non referred to as what? Non-current assets. Non-current assets. Examples include, and so of two types, you have tangible, which entails like property, plant, any item that fall under property, plant, and equipment. And we have what? Intangible. Example include goodwill, patent right, copyright, and etc. And the other category of assets is what I call current assets. Non-current assets are assets that are expected to generate economic benefit for more than 1 year. For current assets, the economic benefit are meant to just last for the period of 3 months, at least 1 year. So the asset that fall under current asset include stock, which is known as what? Inventory. We have balance in cash in hand, which is cash at bank. We also have what again? Receivables, which was sometimes known as what? As debtors, and etc. So this is what asset entails. I've taken my time to categorize asset. Now let's move to the second element of our what? Second element of financial statement. So the second one is what? Is the liability. Liability is simply defined as is a present obligation. The obligation arises to do with indebtedness. It has to do with owings of an entity, which is arising from past events. So it arises as a result of what had happened in the past, which resulted to now. So for instance, I came to borrow something from you in the past, and I'm still going to pay you sometime soon. So currently, I'm owing you. Now it is a present obligation that arose from past events that happened sometimes ago. The settlement of which is expected to result in outflow of resources that embodied economic benefit. So the liabilities is a present obligation of an entity that arising from past events, in which the settlement of which is expected to result in an outflow. So if I'm settling my indebtedness, my obligation, there will be an outflow of resources, be it cash that embody what economic benefit. So liability is found in a statement of financial position. A statement of what? It is found in the statement of financial position. And we have two categories of liability of non-current of liabilities. We have what? the non-current liabilities, which includes long-term loans, bonds, etc. We also have the second category is what I call the current liabilities. What do I call it? Current liabilities, which include one, we have bank overdraft, bank overdraft. Two, we have what? Payables, payables, and etc. So these are examples of items that falls under current liabilities, and two, items that fall under non-current liabilities. So this is the second element of financial statement. Now the third element is what I call equity. This is also found in the statement of financial position. Statement of financial position. So equity is the residual interest in an entity after the value of all its liability has been deducted from the value of its asset. It is the balance sheet of the entity's net asset. Does not represent any way the market value of the equity. So it does not show. It's just the difference between the total asset of the company, the total assets from its total liabilities. So what I is not the market value of the equity. However, equity may be subclassified in the statements of financial position, like I said earlier, into what? Share capital 1, retained profit 2, so the embodied share capital is embodied retained profit, and other reserves, which is 3, other reserve, evaluations of loss, general reserve, and the like, that represent capital maintenance adjustments. So do you get that now? So this equity is just a residual interest in an entity's after the value of its asset, after the value of all that liability has been deducted from the value of all its assets. So this is, and it embodies the share capital, retained profit, and other reserves. Do you get that now? So this is what equity entails. So let's now move to the fourth element of financial statement. So this is which is known as what? As income. Which is known as what? As income. And income is seen under the statement of financial of profit or loss, which is classified under financial performance. Financial performance is measured by profit or loss. Profit, so it is being measured. To measure the performance of a company, we consider what its profit, if profit was made, or what if loss was made. Profit is measured as income less expenses. Income include both revenue and gains. The income is majorly classified into what revenue and gain. Let's look at revenue and what gain means. Revenue is the income arising in the course of the ordinary activities in any entity. So any inflow of cash, any inflow of monetary benefit, any inflow of benefit as a result of the ordinary operation, the activities, the normal operation of the business is such income is classified as what? As revenue. It includes sales revenue, fee income, royalties income, rental income, income from investments, and the likes. And for gains include gains on disposal of non-current asset. I'll explain to you what current asset is. So where there is an item of non-current asset that has been disposed, that has been sold, and they made the gain on such disposal, that gain is classified under what? Income, under the gain part of what? Income. Realized gains are often reported in the what? Financial statement, net of related expenses. They might arise in the normal course of business activities. Gains might also be like the what unrealized. That is, it has been what the value has been what has been realized, that is, it has been received duly. Unrealized gains occur whenever an asset is revalued upward but is not disposed of. So when there is unrealized gain, that means the value of the asset has been revalued. There is valuation surplus, but the gain, but the asset has not been disposed. For example, an unrealized gain occurs when marketable securities owned by the entity are revalued upwards. So this is an example of what of an unrealized gain. Now, the last part of the element of financial statement is what expenses. This can also this falls under what the statement of financial of profit. Sorry, pardon me, profit or what or loss. Sometimes you say they call it as statement. They call it income statement. Income statement. So depending on what the examiner wants. Expenses include one, expenses arising in the normal course of activities such as cost of sales and other operating costs. Do you get that now? So expenses result in the outflow of assets such as cash or finished goods and inventory, or the depletion of assets as a result of what depreciation of non-current assets. The other category of expenses is losses as a result of what disposal of what of non-current assets. So when a company tend to realize loss when the amount they sold the asset is less to what to its value, to its current value, to its current value with its book value. So when such losses is classified as an expenses under the statement of profit or loss account of the financial statement. So let's also now move to recognition in financial statement. Recognition in what? In financial statement. The International Accounting Standard Board Conceptual Framework, Iasb'S Conceptual Framework, states that an element, of course, you know what element is, either an asset, liability, equity, income, or expense, should be recognized in the statement of financial position or statement of profit or loss when one, it meets the definition of an element. That any transaction that does not meet the definition of an element, that is an asset, liability, an equity, income, or expense, should not be seen in the statement of financial, should not be seen in the financial statement. And two, it satisfies the requirement for recognition. Every transactions must what? There's requirement for it being what? Being recognized. So if it does not meet the requirement, it must not be what? Be recognized. Items that fail to meet the criteria for recognition should not be included in the financial statement. However, some of these items may have to be disclosed as additional details in a note to the financial statement. The criteria for recognition are as follows. One, it must be probable. So these are the criteria for recognition for every of the elements. So they must fall under this under this criterion. One, it must be probable that the future economic benefits associated with the item will flow either either into or out of the what entity. So there must be a probability of what of future economic benefits flowing inside into or out of the entity. And two, what if there is no probability of the flow of economic benefits associated with such item, it won't be recognized because it's not meeting the recognition requirement. And two, the item should have a cost or value that can be measured reliable. It must what have a cost or value that must be measured reliable. So if it does not have any cost, if it does not have a monetary cost or monetary value, it will not be what recognized in the what in the as an item as an item under the financial statement. So please take your time. These are the criterion for recognition of an item under the element in the financial statement. If it does not meet this recognition, it is not permitted. It is not permitted to form part of the requirements. Other accounting concept. So at this juncture, we're looking at the other accounting concept. One of the other accounting concepts, sorry, that we need to know is what is materiality and aggregation. What did I call it? Materiality and what? And aggregation. Materiality and aggregation. IS1 also states that each material class of its similar item should be presented separately in the financial statements. So where they are the materiality concept, we're really talking about the material, how important a transactional item is. So at the point it says if there are two similar items that have similar class but they are of material, they should be presented separately in the financial statements. The relevance of information is affected by its materiality. So materiality talks about the effect of such item. If it's been omitted in the financial statement, what effect will it have? If the effect will be significant, if it's it's a material item. If it is not, it is not a material item. Its materiality is not that really strong. Information is material if what? Yeah, this is where I'm going at. Information is material if omitting or misstating has to do probably you overestimate its figures or you underestimate its figures. It could influence decisions that users may make on the basis of financial information about a specific reporting entity. Second, the second concept is what I call offsetting. What I call it, or what offsetting. IS1 states that asset and liability should not be what offset against each other. If you remember in secondary school, they do mention this under what under financial position. I am asset and what liability should not be what to offset. Which should not be offset according to what IES. IES means international accounting international accounting standard. Similarly, income and expenses should not be offset against each other. Instead, they should be reported what separately. So they should not be offset. They should not use one. They should not use one to offset each other. They should not set them off. They should what report them separately. The exceptions to the rule are when one, offsetting is required or permitted by an accounting standard or the interpretation of a standard. Two, offsetting reflects the economic substance of a transaction. So if it does not fall under any of these two categories, such an income or should not be offset from an expenses, or the asset should not be offset from the liability. The other one is consistency of the other concept. What is consistency of what? Of preparation. Consistency of preparation is needed if financial information is to be comparable. So if for me to because comparability I've explained to you is one of the qualitative characteristics of financial information as comparability. Yeah, and which it won't be possible for me to compare what happened this year with last year under two different parameters. Do you get that now? So if there's consistency with respect to the preparation and presentation of financial statements with the respective years, it will be very, very easy for me to carry out a comparability analysis of those two transactions. I just want to say that there should be consistency in the preparation and classification of items in the financial statement from one year to the next. There are just two exemptions to the requirement for consistency. The first exemption is where consistency is not required when it is apparent following a significant change in the entity's operation. So when there is change with respect to the operation of the business, then the consistency would be what would be affected. Do you get that now? Change my maybe the company wants to change the account the way at which the method of depreciating its assets. So whenever they want to change it, it would affect the consistency. That means The presentation methods for last step would be different from that of the one is forward this year, which would be as a result of what of the change in the entity's operation, or two a review of its financial statements, that the different presentation or classification would be what would be more appropriate. Prudence, another concept. Prudence involves allowing for some caution in preparing financial statements by making reasonable and sensible allowances in order to avoid overstating assets or income and to avoid understating expenses or liability. So prudence is an important concept under the accounting, and its aim is to ensure that uh, business avoids overstating either its income or assets, or avoid understating expenses or liability by reasonable and sensible allowances to its transaction. So this is what prudence concept has to just do in the account. So caution should be taken in preparing the financial statements. If allowances are to be made, you should be reasonable to the point that it will not result to overstatement of one's asset or income, or understatement of what of the expenses or what or liability. As a general indication of prudence, rules exist to prevent a business recognizing an asset in its financial statement at an amount greater than the cash it will generate. When such a circumstance arises, the asset is reduced in value down to the cash expected to result from the ownership of the asset. So this is emphasizing on the prudence concept. The other part now, as we come to the end of this topic, is what I refer to as fair presentation. What I call it, fair presentation. Financial statements are often described as showing a true and fair view, or presenting fairly the financial position, the and what performance of an entity and changes in its financial position. So if I want to give an assignment, when you just get a newspaper or get Financial Times, get Financial Magazine, and check the financial statement of the organization that has not audited. Of course, you will see a statement that the financial statement prepared is of I mean, as part of the auditor's report, it shows a true and fair view, or presenting fairly the financial position. So what fairly just talking about is ensuring that the financial statement is prepared with serenity, and there is no issues with changes to its financial performance, and with respect to its position, it is regards to truth. There is no any form of biasness with respect to it. IS1 states that fair presentation requires the faithful faithful representation of the effect of transactions, other events and conditions in accordance with the definitions, recognition criteria for assets, liabilities, income, and expenses set out in the IASB framework. So it's talking about just what the fair part talking about. It's talking about the faithful representation of the effect of those transactions. So what I'm looking at is looking at the is ensuring that such transaction is of any of the elements in the financial statement should be faithfully represented. Use of faithful representation means more than that of than that the amount in the financial statement should be materially correct. I come again. The use of the term faithful representation means more than that the amount in the financial statement should be materially correct. It implies that information should present clearly the transactions and other events that is intended to represent. You get that now? So it's not just talking about correctness. It's also making emphasis on on also presenting other transactions that are intended to be represented in the financial statement. So at this point, we've come to the end of this topic. I am sure you had a wonderful time. So take your time, go through it over it again, and to have a better understanding. See you in the next class. Bye for now.